will discuss today about Chinese economy and how is it doing right now. It's not doing very well actually. So one of the fastest growing economy in the world is not doing so well. It's the second largest economy in the world after the US, and it has a very special importance in the world economy actually for various reasons. One of the main reasons why Chinese economy is so important for the world is because China is the biggest exporter of many goods and services. So, you may be knowing that most of the parts of iPhone are manufactured in China, and not just Apple but many other multinational firms depend on the Chinese manufacturing sector. So Chinese economy is very important for various reasons, but among others the export is so important for the world economy. And we're going to be discussing about what's going on in China at the moment. Not doing very well. It's in trouble for various reasons. It did well actually managing the COVID crisis over there, but after then, it did well actually. Even the economic progress was very good, and everyone is thinking, but what is China doing right? But now it's actually in a mess for various things. Especially the housing market is doing very badly, and it's not just because of the COVID crisis. Actually, this was in the making for many years now. So a lot of things are happening. There is this paper from World Bank. Some of the people who have written this wonderful paper between shocks and stimulus on Chinese economy. And the special topic, it is about real estate vulnerability and financial stability in China. Many topics they have discussed, starting with how COVID-19 affected Chinese economy, followed by what's going on in the real estate market. So these are the list of topics discussed. About global outlook, because it's not just China which is in trouble at the moment, it's also the other economies in the world. The US, the European countries, everyone is in trouble. But China is a bit more in deeper crisis than other countries, because for other countries it's more of a macroeconomic type of crisis, whereas in China the real estate crisis that is happening now there, it's not very related to the global crisis that is happening at the moment. It was in the making for many years now. There was a huge boom in the real estate market in China for quite some time, especially in the last 20 years, during which China grew at least 7 to 8% a year, and many Chinese people moved from lower income group to the middle income group, and they wanted to buy houses in cities. Many people moved from villages to the cities and towns, and that's when the real estate market really did well. In fact, the real estate market contributed about 12% to the final GDP, overall GDP in China, which is massive actually for a country like China, and that is not doing well. So something is going wrong. And we'll also see banking crisis, tech crisis. A lot of the tech companies are also not doing well in China. Funding has actually come down in China. The venture capital funding has come down quite drastically. Then some of the good IPOs, the very famous IPO, for example, IPO of Ant Financial was stopped by the government. Financial is very much related to the Alibaba group, which is the biggest e-commerce firm in China, and Ant Financial was about to go IPO, and a very famous news a couple of years back, but then the Chinese government cracked down on it for various reasons, and it went on doing that to many other tech companies, and that's also is impacting the growth. Main reason is that the real estate market. All right, we will go through these papers. We can't go through the entire paper, but we will go through the executive summary and try to understand what's going on. There's this news item also I was going through. For example, this CNN, which goes like this: China's economy is in bad shape and could stay that way for a while. The world's second biggest economy is grappling with the impact of severe drought, and its vast real estate is suffering the consequences of running up too much of debt. So that's very important to know. Chinese real estate firms are very debt ridden. In fact, real estate companies are often very debt ridden. So the debt financing is actually very, very high in the real estate sector. Yeah, so when the debt to GDP, when the company is highly leveraged with so much of debt, then chances of going bankrupt is also quite high. So too much of debt is very difficult to handle. Thanks to lower interest rate, many of these companies were just taking loan. Even consumers were taking loan, but the house prices were just shooting up. But that's in bad shape now. It's not. So it's bursting at the moment. So the boom is bursting. Major policy shifts before the party congress appear unlikely, although we could see a softening certain policies in early 23. Yeah. Even then, parties running short of both time and available policy levers to address many of the most pressing systemic threats to Chinese economy. The economy will continue to worsen in the next few months. Tightening of COVID restriction, another reason for that. The problem with journalists writing about economy is that they just give opinion. They just don't state facts. This is happening in CNN. In world's biggest and finest media company. Why can't they show some graphs in this economic report? Economics is very data heavy subject, right? So good to provide some graphs and charts and so on. It's easy to understand rather than just writing in words and giving opinion about people, some random people or random economists working in banks and other places. All right, so but we will go through this World Bank paper, which is much better. Okay. After a strong start in early 2020, the largest COVID-19 wave in 2 years and resulting mobility restriction have disrupted Chinese growth normalization. It goes without saying, it has hampered growth in all countries, all economies in the world, and China is no exception. The global environment has also significantly worsened following Russia's invasion of Ukraine. So, the global economic situation is not very good because of, first of all, the pandemic, followed by the Russia's invasion of Ukraine, which has created just too many issues: supply chain disruptions, energy prices, commodity prices, crisis, and not to mention the second wave, third wave, the Omicron wave, which has been taken very seriously by the Chinese government, unlike other governments where the restrictions are not in place in most countries now. But Chinese government is still interested to control the virus through strict lockdown. That has happened. When I talk to my Chinese friends also, they tell this to me that even now, even right now in September 2020, when they return to China, they have to stay in quarantine for 2 weeks, and they're not allowed to go outside. However, economic momentum plunged in March and April. So I think initially it did well. There's a growth of about 4.8%, whereas in March and April, things started to get worse. The outbreak also led to dip in trade flows. So outbreak means the Omicron. Okay. Real gross domestic growth is projected to slow sharply to 4.3% in 2022 still, which is still quite okay. 4.3% is not a very bad growth rate, especially for a large economy like China. Okay, which is 0.8 percentage points lower than the projected in December. So that's lower than the expected GDP growth rate. This downward revision largely reflects the economic damage caused by Omicron outbreaks, the prolonged lockdown. So this is very important. In China, the lockdowns were very prolonged, I think, for months and months. Growth momentum is expected to rebound in the second half of 2020, which is not happening. By the way, this paper was written a couple of months back, and as we speak, we read in the newspapers that it's not happening. It's getting worse actually, thanks to the real estate crisis happening there. So why it is expected that it's going to do well in the future? Because aggressive fiscal stimulus, there is no news yet, monetary easing, and further relaxing of housing sector regulations to mitigate the economic downturn. Okay, but nothing has come out yet. Okay, these were expected things, but the government hasn't taken these steps. The growth outlook assumes that China's dynamic zero COVID policy will be maintained in the short term to avoid stressing its healthcare system. So this is very important. China is still worried about not being able to handle the crisis, the corona crisis, and burden its healthcare system, and hence the strict lockdowns are still in place in many parts of China wherever there is an outbreak, and that is causing a lot of issues, especially with respect to the supply chain and so on and so forth. It's an export economy, right? So you expect you need to have very good supply chain, otherwise that will get impacted. The likely scenario is recurrent and localized COVID outbreak with short-lived mobility restrictions that are expected to be less destructive. Investment growth driven by infrastructure investment is projected to accelerate, partly offsetting weaknesses in real consumption growth. And external demand weakness, supply side constraint persists. The current account surplus is projected to narrow to, so there is a current surplus, right? There is not in deficit. So that's also an important point to note, that China is exporting more and importing less, unlike in many other countries where current account is a deficit, including some of the developed countries, by the way. And the surplus will come down to 1.3% of the GDP. It used to be higher. With higher imported food and fuel prices, consumption price inflation is expected to rise but to remain below the People's Bank of China annual about 3% inflation factor. So China is still kind of a emerging economy. It's not a developed economy yet. And in emerging economy, the price inflation target is about 3 to 4%, and China is the People's Bank of China, central bank in China, is expecting somewhere around 3% inflation rate. Risks to Chinese growth are unevenly balanced and downside risks pivotal. Okay, so downside risk means it is likely to do worse than better. Okay, so that is the expectation from the World Bank. The most prominent downside risk remains those related to the pandemic. I think also the real estate sector, which is not very it's not doing well because of the pandemic. It's also for other reasons. The re-emergence of new and highly transmittable variants could lead to more prolonged disruption and complicate the exit from China's COVID strategy, which is quite strict, by the way, now. Risks could also emanate from persistent stress in the real estate sector with wider macroeconomic and financial ramification. Persistent stress in the real economic sector. Okay, so that could also be this could be triggered by recurrent COVID outbreaks with discouraged prospective buyers. This could be triggered by recurrent COVID outbreaks with discouraged prospective buyers, which is fine, which is used to happen in some months back during Omicron. People were not buying houses, but I think things have normalized. in most countries except maybe for China, where lockdowns are still in place in some parts of the country. Reducing financial sector. Okay, Chinese economy is also vulnerable to risk related to global outlook. It goes without saying because China is an export-driven economy, and any export-driven economy will get impacted when the world economy is not doing well, because many other countries are not in a position to buy things from China, right? To import things from China. So that is, so then it's quite obvious that Chinese economy will get impacted. The fallout from the invasion of Ukraine and related ongoing global supply and trade disruption may prove more persistent than expected, contributing to burgeoning inflation pressure, as evidenced by sharp increase in the global input cost. This is happening everywhere in the world. Sharp increase in the input cost, commodity prices, and that is actually having a huge impact on the inflation level in many countries, and China is not an exception. It's also happening in China. So inflationary pressure will also have a downside effect on the overall economy. On the upside, if the pandemic is brought under control and domestic restrictions are fully lifted, full year growth could be higher. That hasn't happened, by the way, yet. In the short term, China faces the dual challenge of balancing COVID-19 mitigation with supporting economic growth. The government has stepped up macroeconomic policy, easing with large public spending, tax rebates, policy rate cuts, and more dovish stance on property sector. So it's property sector is now the focus. I think for a large part of the big cities like Beijing and Shanghai and in those places, it's already a bust. Like properties are down by 30 to 40%. I think some of the fund but even defaulting, some of these real estate funds are defaulting on because of the devaluation of the properties and the fact that not many people are now buying houses. While China has the macroeconomic space to counter the global slowdown, the dilemma facing decision makers is how to make the policy stimulus effective as long as mobility restrictions persist. Protracted COVID outbreaks are adding to economic uncertainty, which is in turn is weighing on private investment, consumptions, and reducing the effectiveness of policy measures. Yeah. So there is not yet a new outbreak. However, we are entering the winter, and that is when we expect the cases to rise. It has already started, by the way. As we speak now, the numbers are increasing in many parts of the world, in Europe especially. So it's quite likely that winter will be a tougher season for the China, for any other country, also China. Beyond dilemma, the policy effectiveness is midst of recurrent outbreak. There is a danger that China remains tied to old playbook of aiming to boost economic growth through debt finance instrument stimulus. Okay, it's mostly about COVID and how it's going to impact, and the fiscal policy around this. But what is very important to note is how is the future look like for China. In 2021, the growth rate for China was 8.1%, which is quite impressive compared to 2020. Well, in 2020, many countries suffered a lot and GDP growth in many countries was negative. China still managed to have a positive growth of 2.2%, quite impressive. But for 2020 and 30 and 24, the forecast is about 4.3%, 5.2%, and 5.1%, which is not very bad but for a country like China, it is bad. But I think this is a bit optimistic. Okay, this may be a bit optimistic. It could be somewhere around 4%. I was reading some of the other newspapers. I think they were forecasting some 4.5%. And there are some other indicators as well, so things are going to not looking very, very good. And then the focus chapter is more on the real estate vulnerability and financial stability in China. The issues are coming mostly from the real estate sector in China. So, right. Okay, good stuff. thank you guys. If you have question, anything you want to contribute, anything, please let me know. You can also post your message in the chat box. So yeah, so we are discussing about the Chinese economy today and why it is doing so badly, why the Chinese economic growth is declining at the moment, right? China's housing market downturn in the midst of an economic slowdown has put a realistic vulnerability in the spotlight. So there is already a downturn in China because of COVID, because of supply chain issues, because of Ukraine and Russia war. But what is mostly in the spotlight is the Chinese real estate sector. In the midst of the economic downturn, the real estate sector, the issues of the real estate sector is something that China is dealing with, and it's causing a lot of issues to the general economy. And for 2 decades or all, for a long time, right, for last 2 decades, China's real estate sector was doing quite well actually, thanks to the economic growth, right? Many people moved from the middle class to the upper middle class, and some lower middle class people moved to to the middle class, and they became aspirational. They wanted to buy houses in cities and towns in China, especially in big cities like Beijing and Shanghai, where the property prices just they simply went up, and it was very difficult for companies to keep up with the demand. There was huge demand in the market. Many people wanted to buy houses, and there's simply not many houses, so prices were simply going up. And funding was quite easy actually. Many real estate firms got easy funding from banks, so it was incentivized. It really helped actually Chinese economy, because you see that as of end 2021, the total real estate investment stood at 12.9% of GDP, which is actually massive, right? Larger than many other countries, right? You look at India, you look at UK, you look at US, it's not that big. Like 13% is just the real estate sector, 30% of the overall GDP, not the case in other countries. Whereas in China, that is a very, very important part. Meanwhile, property prices in China are among the most expensive, right? Even compared to New York and Paris and Tokyo and London, the prices in Beijing and Shanghai are much higher. Okay, look at the average GDP in France and compare it with that in China or with UK. You see, the average GDP in China is about $10,000, which is much less, right? Like less than 1/3 that in France. But the property prices in Beijing is as good or probably even more than that in Paris. So that means some elite section of the society were controlling the property market very well, and they're buying too many properties thanks to the economic growth and so on and so forth. But it was happening at a pace that was unprecedented, and the government wasn't prepared for it. Since it was contributing to the overall economy, it was allowed, but there was no plan as to how this will be landing softly. So how there will be a soft landing to this growth, and now it is busted. One key feature of the expansion of the property market has been the high levels of leverage. So leverage means high debt. Okay, so they're not financing through cash. They're just the real estate firms are building the properties through debt, to taking loans from banks. So there is no equity, there is no cash. It is pure loan, right? And when there are no buyers right now because of variety of reasons, they're in trouble. They can't pay the interest to the banks, let alone the principal. So they're going bust, and a lot of them are becoming bankrupt. Recent efforts by the authorities to reduce developers' indebtedness triggered a liquidity crisis in the second half of 2021, as several large developers defaulted on their debt obligations. Several large defaulted on the debt obligations, and I think this one of the biggest also firm, like some 300 billion or something. It's called AMC. What is it called? China Real Estate fund crisis or bankruptcy. What is that firm called? AMC? Or I'm not able to recall, but there is a very famous Chinese firm, prominent Chinese firm, I think went bankrupt some couple of months back. Oh, this one, Evergrande, right? Evergrande or something like that. Yeah, so this, I think this is a real estate fund, and it went bankrupt. I think there's huge uproar happened. It affected even the global economy. Many stock market was down for a couple of days. Some more than 100 billion in assets they're managing. I think more than that even. Okay. Where were we? So we were discussing about this Volcan report, right? Yeah. So this has been in the making for many years now, right? It just didn't happen because of the COVID, because of the lockdown. Of course, that triggered it, right? The recent macroeconomic situation in the world triggered this, but this was in the making for last 20 years, for last 2 decades, when China was growing at a very, very fast, high rate, and it's not a surprise actually. A country which is growing at a very high rate is likely to have issues, right? Likely to have downturn in some of its economic sector, and real estate is one such sector which is quite vulnerable, because when the economy is growing, people will like to buy their own house, to improve the living standard, and that's because of aspirations. But some people will not be able to do that, and at some point, because the price, the demand is more than the supply, prices are going up, and at some point it will stop, and then it will move backward, and that's exactly what's happening at the moment. Okay. Although financial sector appears resilient to immediate shocks, that means financial sector is not that in trouble at the moment from the property market downturn, there are vulnerabilities that warrant close attention going forward. So there are still some vulnerability because the real estate sector is very debt ridden, and banks are very exposed to these debt ridden companies, so we have to watch out. But good thing is that Chinese banks are very much domestic. They don't have exposure outside of the economy, so it will not, or less likely to have impact outside of China. Indirect impact for sure, but direct impact on other banks outside of China less likely. I don't think foreign banks have lent money to the Chinese real estate firm. These are the domestic funds, domestic banks in China. I don't think HSBC would have given money. I don't know, maybe. The overhang of uncompleted housing, especially in some lower tier cities, the rising pressure on household balance sheets, the ongoing distress of developers and economic slowdown could keep demand for new houses weak, and that's important. The demand is actually very, very low at the moment for a variety of reasons, especially unemployment is very high, and people are also worried about what is going to happen in the future, and the stock market is not doing well in China, so people have lost money in stock markets, and they don't want to invest money right now in real estate, also thinking that it has peaked, it's a bubble actually, and people realize that now, and they don't want to buy houses, and the demand is very weak at the moment. Further relaxation of regulatory controls to reignite investment risk, storing up more trouble down the road. The aim for policy in the short run should thus be to stabilize the market and create conditions for its orderly restructuring. For example, extending the transition period for compliance with the 3 red lines beyond in 2023 would give developers more breathing space to adjust, but allow authorities to continue to monitor developers closely to ensure there is genuine progress towards deleveraging. Now, the deleveraging is not that easy actually. It is easier said than done. What are you going to do? Will the government step into the shoe in the shoe, and will there be sort of a stimulus package given to these funds, to these real estate firms? It's not that easy actually, because that runs into some hundreds of billions of dollars, and whether that will be easy to fund for the Chinese government is a question mark. A couple of days back, the UK government wanted to fund certain things with over 100 billion pound being put into subsidizing the utility bills of people, and see what happened to pound now, right? More crisis for the UK, more issues for the UK economy. So in addition to finding the right balance between stabilizing the market and controlling risk in short term, several structural reforms would put the real estate sector on a sounding foot. Now, structural reforms are long-term reforms, right? So don't expect that in a couple of years' time. For example, there is a significant scope to enhance the livability and economic viability in the inner cities in China, whilst increasing their density and thus moving away from extensive model of urbanization followed to date, which is actually the issue, right? The focus is entirely on the big cities like Shanghai and Beijing, and it's becoming overcrowded, whereas the other cities are getting less attention. So mitigating a bit of a risk to other cities is a good one, but it's not a short-term thing. Changes to urban master plan, blah blah blah, okay, that these are fine, but not going to solve the issue. Okay. Financing options for real estate developer could be broadened through expansion of project-based financing or greater participation of institutional investors such as real estate investment trust. I don't know what that is, which are oriented towards property development. Okay, so specialized trusts which are oriented towards real estate development, and not the banks taking the pressure of funding these real estate firms. And I don't understand how that is going to change, but maybe these firms are more specialized, so they can take better decision as to which companies to fund and which not to fund. The distress of large developers has also underscored the need for robust and predictable framework for debt resolution. It's a problem in all countries, especially in emerging economies, and certainly China, which would facilitate the reallocation of capital to support a more innovative-driven private sector-led growth. Finally, further liberalization of the financial system is essential to expanding the range of financial assets as available to households as investment option, and reduce propensity to buy and hold empty property as investment vehicles. This is also a good thing, because in China a lot of people were simply buying property to as an investment, as opposed to willing to live in those properties because they already have a house. And that was so point is that if there are other options of holding assets, then people will not simply buy property for investment, but that will reduce the demand further, right? So that is a long-term plan, but nothing. And this is the Chinese economy in graphs. So what is this? Is this the growth? This is private sector credit growth. You see it is going down over time, which is a wrong signal actually. Normally credit growth in a good economy should go up. GDP growth was down in 2020, is up now, is again down. Real estate investment there was a steep growth, right? You see from 2000 to 2015 there's a steep growth in the real estate market, but now it is stabilizing, and then it is even going down. Total liability of the developers in GDP, percentage of GDP, really? Trillion RMB and percentage of GDP, really? So you mean 80% of GDP? That insane, right? So Chinese economy is about $14 trillion, 14 or 15 trillion dollar. 80% of that is like 12 trillion. like $12 trillion as a date or liability. Wow, this is insane, right? So just see how steep the market is. Like it was in 2020 it was as low as 20%. Now it is as high as 80%. So in 10 years time, in just 10 years time, it has quadrupled. This is insane. So the burst is bound to happen. Then the economy burst. Okay. Yes, you're right, Yogesh. Yeah, please email us, Yogesh. Yeah, thank you. Please email us. I'll share the details. Okay, so that's about what's happening. So this is so we went through the summary, the executive summary. Yeah, more details can be found out in this particular paper. I will share the details. Well, you can see it over here. This is the paper. If you want to go through, you can go through. Some more graphs. This is GDP growth and how it is changing over time. It's quarterly, right? And I think this is the lockdown period when there was outbreak there. Fixed asset investment, it was very bad in 2020, got better in 2021. It's doing badly now again. This is data at more granular level, like for big cities and other parts of China. Container through Shanghai port. So this is more to do with the supply chain. So it was doing well actually in 2021 and started doing very badly because of Omicron in second quarter this year. So about province, how provinces are dependent on that. Industry and investment growth 2021 again very good, but after that very bad. Savings rate is stabilizing. It increased again a bit, but now things are getting worse. Household expenditure increased quite steeply in 2021. I think everybody thought that we're going to be having a post-pandemic growth, but that's not happening. So we are almost in recession now. So you see it is going down. Trade has slowed. You see the trade has slowed. Export has slowed, right, from 2021. So there is a downward slope. But import has increased, right? But China is a net exporter instead of import. There is the service sector growth is less impacted because it's less dependent on supply chain. Yeah, this is also important. China has turned into a net importer of food, but its net imports of food will still represent a very small share of GDP. It wasn't the case before. China's direct trade and investment exposure with Russia and Ukraine. Right? With Russia there is a huge exposure, massive. But it's not that huge actually, it's part of GDP, right? It's just 4.4%. Okay, so that's not an issue. Alright, So good discussion, right? I will go through this paper even further. Actually, it's rather long paper.